Let's take a look at Money Matters. The JSE Index is slightly down after 3 straight sessions of gains as local focus turned on South Africa's third quarter GDP data, which came in weaker at 0.2%. Grant Nader is with Benguela Global Fund Managers. He's the senior portfolio manager there, and he joins us now for the latest market moves at midday trade. Grant, thank you very much for your time this afternoon. Let's start with an overview of how the markets are faring so far. Have they dissected the latest GDP print yet?
Good afternoon. Well, the markets have remained more or less as they were before the data came out, and I think the fact that it disappointed, as you've mentioned, it came in slightly worse than expected, is not enough to move, to change people's perception. We all know it's difficult out there, and remember that data was up until the 30th of September, so it's backward looking, and it was the 3 months up to the 30th of September. So we try to be forward looking in the market, tending to look 6, 12 months out, and if you're doing that, you can kind of accept that GDP number, factor it in, and sort of look at the opportunities from here, because of course there's a positive potential outcome, and that is the prospects of rate cuts are improving, and as we see rate cuts improving and we overlay that with potentially some sort of easing and load shedding and other improvements, we can see actually that perhaps we've seen the worst of what SA's outlook is at the moment. So yes, it's not a good number, but I think that's probably in the past. And I think looking forward, we've probably peaked in terms of negativity.
Okay. Let's take a look in detail at the GDP data. So talk to us about some of the industries that dragged down the growth and some that really performed well.
So on the detractors side, it wasn't really too much of a surprise. We saw mining, agriculture, construction, and manufacturing. Now, those are obviously very energy intensive. And they require load shedding to be at a minimum, and of course they've been hit the hardest. So it does make sense, and if you add to that external factors such as the commodity basket, which has fallen significantly, particularly the PGMs, which are a massive contributor to our terms of trade and to employment, they've also been under a lot of pressure. So a lot of pain being taken across the sectors that rely heavily on freight and logistics, where Transnet has hurt them there, load shedding, where we've been hurt by Eskom, as we know, and also some external factors in commodity prices. So painful as it may be, I don't think it should be too much of a surprise. If you think load shedding remains the same or gets worse, you probably can't get too optimistic at this stage. If you think we're perhaps moving closer to the end of it, or at least an improvement in those things, including freight and logistics from Transnet, then you can start to become a little more optimistic. What was positive out of the data was financial services, broadly speaking, held up the GDP. Was a positive contributor. It was also when we looked at the employment statistics, so that is no surprise. A lot less energy dependent, more data and dependent, if you like. So that's the benefit of being in the services industry, and at least there's some positive outlook there.
Grant Nader, leaving good news in the chimney. Thank you for that. AB InBev has posted reports on the progress of its share buyback program. Anything that stood out for you?
I think one just needs to keep it in context. The total program is 1%, less than 1% of the market cap. So it's around $1.2 billion. The company is about $126 billion market cap. So it's not that significant a program. The other thing is it's trading at 20 times earnings, 1.2% dividend yield. So I'm not even sure it's a great opportunity to be buying those shares back. I think they're more trying to make a statement. This is not a number that's going to move the market. Perhaps it's even questionable whether the timing is good. However, it is good when companies put a vote of confidence in their own business. So one can take of it what you will, but this is not a market moving update.
Okay, Transaction Capital reported a 3.3 billion rand fall in annual profits. Talks through their performance.
So it's been brewing for a while. We know Transaction Capital, they had the challenges around the taxi service business. The debtors book grew significantly, and it actually grew out of control. And the taxi industry is under tremendous pressure with inflation, with petrol prices, and the commuter, the average South African who's under significant pressure. They haven't been able to pass on costs, and of course that business is now being impaired. So they're having to write down a significant amount of assets that they were holding, be it in taxis, be it in debtors books, etc. So there's been a large equity impairment, a large capital write down in that business. But management is making some hard decisions there. They're choosing to be very careful and they're not getting emotionally attached, and they're doing what they believe is right for the business. They are going to step away from some of those operations. They're no longer going to finance new taxis. So that's a big call to make. That's been something they've been doing for 20 years. But it is positive that they're willing to make that decision and make that step. And then they're also exploring listing of We Buy Cars, so spinning that out of the business and listing that on the exchange, which in the current, sort of over the last couple of years, has been the jewel in the crown. It's the business that has the most growth potential, the best trajectory for opportunity. And so the market quite liked that. It's far better than repairing the balance sheet and issuing more equity. So that stock is up 10% or so on the day. I think it's a good move. It's at least worth exploring. And this is a tough business that's in a tough space, but it's very encouraging to see them making the tough decisions.
So Financial Services Group Signia saw its total assets under management and administration grow 11.6% to 318.1 billion rand during the year ending September 2023. What drove those increases?
So the majority of that growth came from the retail book. I mean, they have a large IFA network that distributes their products and investments. So that was positive. Of course, the AUM fell 2021 to 2022. So it's good to see a recovery of that AUM, but it is natural, as the markets have recovered as well, that the AUM has grown with it. The other thing to remember is the majority of their assets are actually under administration. So they don't actually manage them, they administer them. And that is a lower cost solution for a lot of fund managers. So that's also, as people seek to save costs in a difficult environment, that also benefits from that. But the retail book grew from around 52 to 61 billion. So that was really the standout positive in the update.
All right. Grant Nader, so far, please do correct me if I'm wrong, but the biggest takeaway is that the worst is behind us. Am I understanding you correctly?
That is not a statement of fact. It is a statement of opinion. Yes, my perspective is that
Sure.
is that if you're looking 6, 9, 12 months out, not next month or the next 2 months, you need to look further ahead than that. And it's clear that the opportunity for rates to be cut in the next 6 to 12 months is quite significant. We not just here but globally, and we'll follow the lead of the global markets. Inflation is falling across numerous geographies, and it's falling quite quickly. So that's opening the door to the global cuts, which open the door to South African rate cuts. As the economy slows, that will also allow the Reserve Bank, maybe tilt their hand. If we see some rate cuts, if we see inflation easing, if we see load shedding, if not turning around completely, but certainly not getting worse, perhaps we'll average stage 3 instead of stage 4 and 5 over the next year. That's an improvement. That's going to drive company earnings. It's going to improve sentiment of the average South African and consumer and businesses for that matter. So I think there's a lot of areas in which at the margin things can be better over the next 6-12 months than they have been over the past 6-12 months. And that's what keeps me optimistic and encouraged.
I'll take that because it's backed up by your own, by the data that you see, right, and the trends that you are forecasting. So on Friday's Mail and Guardian, in their biz brief, it's a very short section where they've got 3 business stories. So you've got 3,500 jobs in jeopardy, and they're talking about steel giant ArcelorMittal. They also include electricity there being a hindrance. You've got Bidvest share price shocker, and another bit of bad news from South Africa's private sector shares and services. Trading and distribution company Bidvest fell close to 10% after it warned of a significant slump in its business. That too has got to do with how consumers are pressed and electricity. And then, get this, Grant Nader, Oceana counts lucky stars. Global food processing company Oceana Group reported this week that canned fish brand Lucky Star delivered strong sales volume growth of 9% for the 2023 financial year. The growth comes amid increasing demand for affordable protein as consumers continue to reel from the cost of living crisis. The sales volume growth is an environment where consumers are under significant pressure, supports Lucky Star's strategy. They talk about their strategy and how it supports it. So while you've got some losers in the midst of what we've been going through, you've also got some winners. But you do ask yourself whether indeed it is winners, right? When we speak about affordable protein and you speak about a country that is facing for children more so, where you're not getting the nutrients that you rightfully need. This is not canned foods or anything, but what do we really need to see when we speak about an indebted consumer, when we speak about a consumer that is under pressure, where you would rather buy canned fish than buy fresh fish or buy chicken or buy other protein sources, right? So help us understand.
So, I fully understand what you're saying, and I think you need to have two separate hats. The one is the hat of the economy, which we can see is difficult, and in reality probably gets a bit more difficult before it gets better. As an investor, you've got to look a bit further ahead. So the stock market tends to discount at least 6 to 9 to 12 months ahead. And so as things may still get a little bit worse, things like the protein wasn't helped by the chicken flu we've had, the bird flu, which pushed up the price of eggs, the price of chicken, and that's of course made what was an affordable protein a lot more expensive. But if you look through that as an investor, that's how you have to see the world. But as a person who's living through it, as we all are, we still think, yes, the pain is there, and I don't think it goes away. What we need to do is stop scoring own goals. So we need to get on top of the Transnet challenges, we need to get on top of the load shedding, and we need to invest in infrastructure. We've talked about it for a long time, but government's actual deployment of those investments and and the impact it can have on the economy is again lacking. So it's really about using what's available to us. We have a number of tools as a government to make a difference, but the deployment and implementation is lacking at this stage. And of course, leading into the election next year, I'm hoping that there's a bit of urgency that creeps in to some of this, and government tries to fix some of the problems before the elections, because they can certainly see themselves coming under pressure if they don't.
Grant, always a pleasure. Thank you very much for your indulgence this afternoon. Grant Nader, Benguela Global Fund Manager's Senior Portfolio Manager.